Welcome to The Explainer. Today, we're going to pull back the curtain on one of the fastest growing and maybe one of the most misunderstood corners of finance, wealth management. I mean, it's an industry that manages an unbelievable amount of money. So how does it actually work? And more importantly, who does it really work for?
So let's just start with the scale of this thing. Get a load of this number. Over 50 lakh crores. That's just the investable wealth held by high net worth individuals here in India. It is a truly staggering figure, and it powers this massive industry that's completely dedicated to managing, growing, and of course, protecting it. And that number, it just brings up some really critical questions, right? How are these firms actually making their money? What are their real incentives? And maybe the most important question of all, whether you're looking for an advisor or looking to invest in one of these companies, how do you tell the great ones from the ones that are just, well, okay? We're about to break it all down. Okay, so first things first, let's take a look at the powerful trends that are driving this absolute explosion in growth. What you're looking at here is pretty much a perfect storm for growth. You've got the industry itself just booming, expanding by up to 20% every single year. That's fueled by literally millions of newly wealthy individuals. But, the really key number here is that last one. Market penetration is still only around 10%. That means the runway for future growth is just massive. So, at the very heart of this entire industry, there is a fundamental choice. It's a choice that every single firm has to make, and it pretty much determines everything about how they operate and who they're really serving. It all boils down to two core business models. This quote just nails it. Think about it for a second. Are you paying for objective advice, or are you paying for someone to sell you a product? You pay a doctor for their expertise to keep you healthy. You pay a pharmacist for the medicine they sell you. Now, both can be useful for sure, but their core incentives, completely different. And that is the central conflict right at the heart of wealth management. So the fee-based advisor, that's your doctor. They charge a set fee, usually a percentage of the assets they manage for you. So when your wealth grows, guess what? So does their revenue. Your incentives are perfectly aligned. Then you have the commission-based advisor, your pharmacist. They earn their money on transactions, which means their revenue is tied to sales activity. And that can create a pretty obvious potential conflict of interest.
And that one choice, fee versus commission, it has these huge ripple effects for the business itself. The fee-based model, it creates stable recurring revenue and, as you can see, much healthier profit margins. The commission model, on the other hand, has to live with this more volatile transaction-based revenue, which needs to lower margins and, not surprisingly, significantly higher regulatory risk.
Now, on top of that business model choice, there's another really important layer here. Not every client gets the same service. Not even close. The industry is highly segmented, and what you get depends almost entirely on how much you have to invest. You can think of the client base like a pyramid. The vast majority, something like 70% of clients, fall into this mass affluent category. Then you've got the high net worth individuals, and right at the very, very top, you have this tiny but incredibly valuable group, the ultra high net worth. So what does that actually mean in practice? Well, the mass affluent group, they're typically getting a hybrid service, a mix of digital tools and some human advice. High net worth clients, they get their own dedicated relationship manager. And for the ultra high net worth at the very top, they receive what's called family office services, which is basically like having a private CFO managing every single aspect of their family's finances. And the difference in the service you receive it's just dramatic. As you climb that wealth ladder, a standardized model portfolio becomes a customized one, and then it becomes a totally bespoke, one-of-a-kind strategy. Standard research reports become premium access, and then they become proprietary insights nobody else gets to see. A basic will evolves into complex trust structures and eventually full-blown multi-generational plans. The depth and sophistication of the service, it just scales right along with your assets. All right, so with all this complexity, different models, different client tiers, how do you actually identify a firm that's built to last? Whether you're a potential client or you're an investor, there are some really clear signs that separate the true winners from the rest of the pack. When you really look under the hood of a winning firm, the numbers tell the story. First, you're looking for consistent growth in assets under management, or AUM. That's key. Second, you want to see really happy clients, and you see that in a client retention rate of over 90%. And third, you want to see that the business is run well, which shows up in high and expanding profit margins. And what's holding it all together? Well, it should be a business model that is primarily fee-based, making sure everything is stable and aligned with the client. And it's not just about the numbers. Winning firms also use some really smart strategies. They expertly blend human advice with technology to serve their clients more efficiently. They don't try to be everything to everyone. Instead, they specialize and they completely dominate a niche. They use what's called an open platform, which means they're offering you the best financial products out there, not just their own in-house stuff. And for their top clients, they offer these holistic services that cover literally every part of their financial lives.
So, we've seen how the industry is structured, how it makes money, and what the best firms do. Now let's pull all of that together into one final, actionable takeaway for you. Think of this as your go-to checklist for spotting a high-quality wealth manager. You're looking for strong growth, especially from new clients, not just market returns. You want to see high client retention rates and those healthy, expanding profit margins. The foundation of it all should be a fee-based model that aligns their success with yours. And finally, a modern tech platform and a really clear strategy. Those are the critical final pieces of the puzzle. And all of this leaves us with one really critical question for the future. As technology and these robo-advisors get smarter and smarter, and they start to master the basics of investing, what is the uniquely human part of wealth advice that will still be worth paying a premium for? Is it going to be behavioral coaching during a market crash, navigating super complex tax laws, or maybe managing tricky family dynamics? Answering that question, that is the single biggest challenge and the biggest opportunity for this entire industry. Thanks for watching The Explainer.